Today, I'm going to explain to you a concept that I use frequently. It's part of my system in trading. It is the fair value gap and the inverse fair value gap. This is going to be a series of videos where I go through the foundation of actually what my system is, every item in my system, so market breakup structure, fair value gaps, etc., how I enter, and just repeating it day after day after day with $1, $2 trades or whatever, cheap. Use BitMEX, sign up for an account, KYC, deposit $25, get 50, take out your 25, free money, and you can learn. So what exactly is a fair value gap? Well, a fair value gap is price imbalance. Now, you might have heard that from ICT concepts or smart money concepts, and that is actually where I learned it. However, if you look back in time, gaps, which is basically price inefficiencies, has been around forever, and the market is pulled towards balancing any kind of imbalances. Once you start seeing them, it's hard to unsee it. It's a zone on the chart where price moves so fast in one direction that it essentially skipped over a range of prices. Basically, the market didn't get a chance to trade on both sides. There's an imbalance, okay? Now, how do we identify a fair value gap or a gap? It is quite simple. It is a 3-candle structure. It's as simple as that. 1, 2, 3. And you need a gap in the middle of those 3 candles. So here, for example, I can mark it out with my parallel channel tool. I love to use that, by the way. Here, it's a gap. Just make it smaller. So this is a bearish fair value gap. Now, let me just mark out some other bearish gaps. Here you can see candle 1, 2, 3, huge gap here. That's a nice bearish fair value gap. Okay, we have a bullish fair value gap here. Okay, here we have another bearish. I mean, there's tons of them, especially on the 3-minute time frame. You'll find, they're everywhere. Now, let's see what happens when we go to the weekly time frame. Here, you can find a weekly bearish gap. Let's mark that out as bearish. And let's see if we can find a bullish one. Can you find a bullish one? Okay, here we have a bullish fair value gap on the weekly time frame. Okay, so we'll mark that out as a bullish fair value gap. Normally, price action is balanced, right? Buyers and sellers are trading against each other price by price at each price level, okay? But when you get one of these large spikes, okay, one of these imbalances or gaps, it means that one side completely dominated the other side. So in this case, the selling, because it's a bearish gap, dominated the buying. In this case, the buying dominated the selling, okay? The higher the time frame, the more we pay attention to the gaps. So if I see a fair value gap on the weekly or the monthly or the daily time frame, 4-hour time frame, I'll definitely, pay attention. So in summary, what a gap tells you is that there was no equal trading, okay, in these zones, in these gaps. Now, if you're wondering why price comes back to this gap, okay, I go by the fact that the market is an auction, all right? Price is always seeking, like I said, efficiency and balance. When you get a massive impulse move up, it's most likely driven by some kind of institutional order or large orders. So large buys in this case might be entering and it leaves an imbalance. When the move is so aggressive, the institutions or large orders do not get their fill completely. So what happens is that they have to push price back down to that gap zone, okay, so that they can fill up what has been left behind. And the market tends to gravitate towards these zones, fill the orders before continuing in the direction. Now that we know what a fair value gap is, let's talk about an inverse fair value gap. So an inverse fair value gap is what happens when a fair value gap fails to hold as resistance or support, creating another fair value gap, but in the opposite direction. So here you can clearly see that we have a bearish gap, Okay, let me just put the bearish gap over here. All right, you have a bullish gap here, and now, now I have an inverse fair value gap. What color can I put that at? Okay, let's do pink. Now I have an inverse fair value gap. So basically it is quite simple. An inverse fair value gap is when a fair value gap on the opposite direction fails to hold as support or resistance. And there's another fair value gap on the opposite side that's created, making it an inverse fair value gap. Now, just so that you know, me personally, I know some people use wicks and all of that for their inverse fair value gaps, but I do not. What I do is I only look at the area between those two fair value gaps. Okay, so we have the bullish one here, the bearish one here. I'm not going to go all the way up here and call that an inverse. I know some people do it, and that's fine. It's not my way to do it. This works for me. May not work for you. You need to backtest stuff and see how it works for you. Because I have a wick here, I'm not going to add all of this area to my inverse fair value gap. So what we're looking at here is that on this side, my bullish fair value gap was support. Then it flipped for another fair value gap, creating an inverse fair value gap, and it made it into a resistance zone. All right, so that is a great thing that you can actually put in your pocket and use it in your trading. Okay, another thing you would find is that if the market is super bullish, sometimes you won't even get a retest of the FVG, okay, of the fair value gap or the gap. So if one of your entry criteria is that you wait until it comes back and it retests, okay, that fair value gap, then you may not get it, okay. For example, here, there's no, there's no retest of this point. It just breaks it down and creating inverse fair value gap. And yeah, didn't get any chance there. In trading, you're not going to win 100% of the time. Now, timing is important for your fair value gap. So there are certain times that I look for fair value gaps or inverse fair value gaps and for entering a position. And those times are 3 a.m. New York time. All my times, by the way, are in New York time. That is where I did my back test. Okay, so I just keep it at New York time. So 3 a.m., 7 to 8 a.m., 9 a.m. of 9:30 a.m., 2 p.m. I've actually back tested all of these time frames. I do have a back testing session where I back tested price movements from 3 a.m. New York time to basically closing New York time. I want to see liquidity builds at this time from 2 to 3 a.m. New York time. I want to see what happens here. I know usually, okay, nothing is 100% of the times. I know there's a false move from 3 to about 4 a.m. New York time. There's a London kill zone that takes out the false move, okay? There's usually a reversal that happens. There's New York kill zone, and this is, of course, smart money concepts that I just use in my backtesting session. Silver bullet is like when I usually like to exit a trade, okay? Then we finally have a lunch sweep, continuation, etc., etc. So those are the areas that I'm going to be looking for fair value gaps or inverse fair value gaps for quick scalps, okay? You guys can go to my trading view, Funky Town Bites, and you can just use this indicator if you want to, see how price action works. It's best used in the smaller time frame. And that is it for me. Quick video on fair value gaps, inverse fair value gaps, how I use them, how I apply it to my trading. If you like this video, do hit like, subscribe, and yeah, see you in the next one. Bye-bye.